exciting news. The ANZ has increased its 4 and 5 year fixed home loan rates by 40 points, which makes it the bank with the highest rates of any of the big four. Matt Gatt, the General Manager from Home Loans at Compare Club, says the ANZ's rate rise shows why it's now become more important than ever for home buyers to lock in a home loan rate as soon as possible, whether they're refinancing or buying. And any fee attached from the change will be more than offset by the savings over the lifetime of the loan. Now, according to Matt, anybody who's waiting on their application with ANZ without locking in a fee will have potentially missed out on hundreds of thousands of dollars worth of savings. Good morning, Matt.
Morning, Michael. How are you going?
Good, thanks. Now, 40 basis points, that's a big leap from what we've seen recently, isn't it?
It is a bit of a leap. So, on an average mortgage of about $500,000, that's a $2,000 per annum increase in interest payments. So it's relatively significant. And considering that that's just one of many increases, it's not the only increase that ANZ and other banks have made, it can add up in the long run. So, I think the longer that people take to think about these things, the less savings that they're going to make on getting their mortgage sorted.
Now, is this a sign to come? They usually all follow each other along. Is there more of this to happen?
Yeah, exactly. Actually, just before jumping on here this morning, we got another notification that CBA has increased their rates again today as well across all their fixed rates. So definitely we're going to see more of this. That's sort of where the market's headed in that, historically, I think over the last, 12 months or so, fixed rate products have been incredibly competitive from a price perspective, and the market conditions have allowed the banks to deliver that. But those market conditions are changing, and the commentary around that is changing, and so we're seeing that the banks are reacting to that. So the changes that we're seeing now, I think, are the first of many to come. And as you said, once one bank moves, generally what we see is that the rest sort of follow suit. It's just a matter of who moves first and who moves last, but inevitably they'll all move in a similar direction.
Now, my quick perusal over the market, those loans under 2% have all but disappeared. Are they still out there?
They are still available. There's still rates under 2%, but as you say, they are the ones that are being targeted at the moment for interest rate increases. So, 6-12 months ago, there were pretty much every lender had a product under 2%, and so mortgage holders and people who were buying properties had a plethora of options around who they went to get those rates. They are very fast being removed from the market, and so we're seeing less and less lenders that have those rates available. So I think it stresses the importance of people reviewing what options they have, what rates are available, and making a decision sooner rather than later if they do want to get those competitive rates, because they won't be around forever, and as we're seeing, they're being increased as we speak. So just increases the importance to review and make a decision relatively quickly so that you get the best possible rate and products.
What's actually prompted the increase, Matthew?
Yeah, I think there's a number of things. I think the longer term outlook for interest rates has changed. So I think commentary from the RBA originally was that there wouldn't be increases to interest rates probably until 2024. I think based on where the economy is at, and particularly the property market is probably change that prediction that those rate rises may come sooner. There's a lot of things in the background that go on around the cost of funding for banks and so forth, as we often hear from them. And so as their costs increase, interest rates increase as a result of that. And so there's a lot of that involved as well. But I guess, it's kind of being flagged a little bit by not just the banks, but also, the federal government and the regulators as well, that the property market is quite hot. And so measures are being put in place to try and soften that at the moment, just to make sure they avoid any sort of larger catastrophe in the market, I guess.
So how does somebody go about, what's the best way for them to go about actually looking and finding a better rate?
Typically, there's two real ways. One of them is DIY, go it yourself, and go to individual lenders, find out what their rates are, what their products are like, compare them yourself, and then make a decision from there. That is quite time consuming, and so if you've got the time, go for it. The second option, which is probably my preferred option, is to engage a professional who already has that information at their fingertips for you. So, you know, a mortgage broker or a financial planner or something like that can help you narrow down what products it is that's right for you. You know, whilst there's some really great products and there's rates under 2% on fixed rate products, a fixed rate loan isn't right for everybody. And so having a conversation with a professional in the industry that understands what the pros and cons of each particular product type are is critical in making that decision as to whether you go ahead with that particular product. But also, you know, the advantage of going through a mortgage broking business as well is that they understand the lending policy that sits behind that product as well. So it's all well and good for a bank to come out with a shiny, sharp rate of, you know, 1.7, 1.8%, but who actually qualifies for that product? A mortgage broker will have that information and be able to better guide you and much quicker guide you to the right product as well.
All right. Now I'm going to ask you to look into your magic crystal ball that you have. Where do you see rates? Will they stabilise, do you think, or will it be a continual incremental climb up? So
yeah, it's a bit of a challenging question to answer because there's a lot of variables that go into it, and at the moment I think there's things are still moving quite rapidly. So I definitely don't think that the rates are going to necessarily drop anytime soon. I think that the only way for them to go is up. It's just a matter of when and by how much. I think what we've seen is that the answer to the when is sooner than we had originally anticipated. So again, it just stresses the importance of people being prepared and looking at their options now as opposed to delaying it and thinking that we've got, you know, ample time to do those things. By how much really will be determined by what the market does. So, you know, and how they respond to the initial rate increases and so forth. So, you know, I think a substantial increase is probably not likely, but who knows in the current market? I mean, stranger things have happened.
Now, we may or may not have a change in federal government at middle of next year. Will that play a part in home loan rates, do you think?
It inevitably does, and I think the whole election period as well plays into what the economy does. I think, you know, sometimes the market activity can slow a little bit until there's a certainty around who the government actually is going to be. So inevitably it will play a role. Which government gets into the federal position will shape what the market looks like moving forward as well, because obviously they're going to have different strategies around how what their focus is. So it will have an impact. You know, difficult to say exactly what that will be, but it always does change the game if we get a new government.
All right, Matthew, one final bit of advice. How often should a home loan owner check their rates? How often should they be perusing the market and checking what's available, do you think?
Yeah, so in the current conditions in particular, I think more often than not is better. Generally, at least every year, get in touch with your mortgage broker or whoever's you know, put your mortgage in place for you and just scan and see what's out there. We go through periods where interest rates, products, lenders change so often, and particularly now we're seeing that, especially with fixed rate products, that if you leave it 3 or 4 years, the money that you're losing by not reviewing your mortgage is considerable. And you know, what we see in our business is that on average, when we're refinancing customers, we're saving them about $4,500 a year on their mortgage. And typically that is because mortgage holders can take too long to make the decision to review their mortgage. So in our view, do an annual review on your mortgage. The worst that can happen is that you figure out that you're on the best product and you don't need to change. The best that can happen is that you find that there's some savings there and there is a better option out in the market, and so you move your mortgage. But definitely 1 to 2 years, you should be reviewing what options are out there.
Well, great information and great advice. Thanks so much for your time, Matthew.
No worries. Thanks for having me. Appreciate it.